Hello, and welcome to Module 7. Today, we are talking about state banks. As I've mentioned, we focus a lot on national banks. They're the largest institutions, the most developed body of law and regulation, but state banks are important. And there's more state banks. They are smaller in size, but there are more of them. And so they're also a very important part of the banking landscape. And a lot of times there's a lot of innovation in state banks because they are smaller and because of sort of the relationship they have with their regulators. So we have seen this chart before, the national banks having the OCC as their primary regulator and their primary federal regulator. With the state banks, their primary regulator is the state. The state charters them, they examine them, they file their annual reports, there's annual reporting, examinations. So the state is the primary regulatory agency, and the state law is the primary law that governs what they can and cannot do. Now, of course, they are still under the FDIC. They all have FDIC insurance, and they may choose to be members of the Federal Reserve Board. But the state is still their chartering law and their chartering authority. So we had talked about chartering a national bank, and chartering a state bank is quite similar, although maybe potentially a bit easier. The powers are going to be very similar. There are times when state banks may have a bit more power, typically through a grandfather type provision. But in general, because of the FDIC insurance, there is sort of a limit on what states can let banks do. The fees will really be significantly lower to become a state chartered bank. So it's less of a barrier to entry. The access to the regulators will be far greater. States actually welcome new banks. They're very pleased to have banks, and they very much want to work with their banks. Not that the federal regulators don't, but the states are concerned that state banks are being gobbled up and going away. So they will really be at your beck and call if you are, wanting assistance or have questions. On the other hand, the state regulators are not going to have the level of sophistication that you see with a federal regulator. And we'll be talking about preemption really more next week, but there is less preemption, but there is still some preemption for state banks. So that's definitely a consideration. And the result being that a state bank is a really good choice for a group of individuals that are wanting to start something that's on a smaller basis, that is really more traditional, lending, deposit taking, working in a local community. Those are really the perfect kind of business plan and the perfect goals for starting with a state chartered bank. And as one of our notes mentioned, it's relatively easy to convert your charter in the future. So you're not stuck. If you become a state chartered bank, it's possible to switch to a federal charter and to have a federal charter and switch to a state, or go back and forth. The chartering process is really very similar. The superintendent, this is, again, we're using the Ohio statute. All states have state banking statutes. We see here they're looking at the convenience and need. They're looking, is this a bank that will have business? Is there a need in the community? Again, thinking of the banking system, not necessarily the success of the individuals incorporating the bank. Again, looking at the competence, experience, and integrity of the proposed directors and officers. Do the people involved, are they honest and knowledgeable? And capital is always, do they have the money? Do they know what they're, so it's really, do they know what they're doing? Do they have the resources to start the institution, and will they have customers? What's a little bit interesting and not particularly unusual is that in Ohio, until 2018, if you wanted to charter a state depository institution, you had, 3 or 4 choices. There was the banking code, there was the Savings and Loan Association code, and there was the Savings Bank code. And in addition to that, there was the credit union. A lot of these had very historical reasons. So a savings bank historically was for kind of people of modest means to save money. It would be a small banking organization for everyday people saving money. A savings and loan would be a different type of an organization that was used to save your money and then get your mortgage. So they would specialize in mortgage lending. And then a bank would be more for businesses and maybe the wealthy. And so each type of institution has different requirements, different powers. But over time, and this happened in Ohio and it happened in really every state, the different types of institutions started to request to have the powers of the other type of institutions so that all of the three institutions were more or less doing the same thing. And so finally, in 2018, they revamped the whole banking code, and there was only one way to charter a depository institution other than the credit union, which still exists and is completely separate. But there was only one type of a bank now in Ohio, although not surprisingly, there was a grandfather provision. So if you had been a savings bank or a savings and loan, there are provisions to carry on as you always have. But going forward, they're encouraging the savings banks and savings and loans to convert to the more traditional bank. But all new institutions will just be banks. That's all that there is. So we did read a case that dealt with a state chartering situation. This, I think it was in Kentucky. Is that right? Maybe I'm wrong there. But anyway, I think what's important is that you see a process back in 1984 that's very much like the process today and very much like the federal process or any state process. You have an application, the regulator reviews it, they conduct an investigation. And in this case, there was a public hearing. Now it's a public comment. I would imagine even in this state, it's now a public comment. And what you see, which again, might be something you're starting to notice, and why one of the reasons you have your regulator that's always watching out and making sure the bank is complying with all its legal obligations, but you also have the competition. So here we have the competition challenging the granting of a new bank charter. And it's kind of interesting because they don't seem to really dispute the integrity of the individuals. There is a dispute about the ownership, how much you're allowed to own in banks. But in general, they don't challenge the integrity and the knowledge of the chartering individuals. What they challenge is the reasonable chance of success and whether or not this is really needed. And this gives you an idea when we see the process the court goes through of really what the regulators look at. Here, as I said, the financial standing, the moral character, all of that seems to be in order. But they did look at the population. Is the population growing? How are the existing banks doing? Do they have enough business? Is there room for another bank to come and be successful? In areas with more population growth, it's more appropriate to have new banks. Here, of course, I feel that the competition who brought this case is really kind of put in their place because the court very much finds that, yes, you bank that brought this suit provide bad services. And these new folks seem way more on it than you. Maybe if you were opened on Saturday, you'd get more business. So this is not unusual. Typically, it's very hard to overturn these regulator decisions on the chartering, but it does show how the competition is watching and may have comments. And the other group that we oftentimes see having comments are going to be the consumer groups. If the chartering entities or chartering individuals rather have a bad history with consumer advocacy and consumer services, we will see consumer advocates challenging granting a new charter to those individuals. Regarding the powers, as I had mentioned, there are times in the past, I would say this was more common, where the states would try to give banks new powers to give them an advantage and to attract chartering groups to come to their states. But because of every bank having the FDIC insurance, there's a pretty hard stop on really what state chartered banks can do, although there are, again, some grandfather provisions. I think we'll talk about title insurance in the future that some states allow their banks to engage in, and it's no longer permitted, but for those who were doing it as of a given date, they can still do that. But this is quite common here. Almost every state will have a law like this, and this is pretty much, how laws are written. And basically it says, in addition to those to what is otherwise authorized, and it's the banking code, those are the sections mentioned there, a state bank has and may exercise all powers, perform all acts, and provide all services that are permitted for national banks and federal savings associations. And the goal and purpose of this is that if there is some new activity permitted for national banks, all Ohio chartered banks will immediately have that power too because of this provision. And it's referred to as a parity provision. And so if you are a state bank and you are thinking of expanding into new areas, this is a very useful thing to find, because if you have this in your state law, it opens up the world of what your bank can do. And because of that, probably every state has something. They may be worded differently, they may have different scopes, but parity provisions are very common because there is this ongoing competition, this dual banking system between the state institutions and the federal institutions. Another issue that is in the state law, and this again is the Ohio Banking Code, is that typically, and we will talk about this more in the next module, interest rates and fees are regulated at the state level. And so state banking laws will set a rate. And as we will see, that is not done at the federal level. So here we see that in Ohio, state banks are permitted to charge an annual percentage rate of 25%. Interestingly, this law then goes on to state that the bank may charge and collect as interest other fees and charges that are agreed upon by the bank and the borrower. And then they list a variety of fees. So essentially, Ohio banking law says the bank can charge 25% interest and any fees agreed upon. I don't know if you've ever negotiated fees and charges at your bank, but I always find it kind of humorous that they say fees and charges agreed upon, because when you open a bank account or get a bank product, it's a pretty much take it or leave it basis. But this does limit the interest rate, but it would have unlimited fees in Ohio. Now, interestingly, 25% was seen not to be sufficient during times of high interest rates. And so more recently, Ohio enacted an additional provision that said, notwithstanding any limitations, and we see this section that we were just reviewing, a bank may charge interest, fees, and other charges under a revolving credit agreement at the same or lower rates or amounts that a bank located in another state may charge its revolving credit customers in this state. What does that mean? I'd like you to think for a minute what you think that means and why it was enacted and why it was written that way. Well, I'll tell you what it means is that a bank, an Ohio bank, may charge any rate that any other bank is charging in Ohio. And there are banks that have Ohio customers that come from states with unlimited interest rates. And what was happening at the time that this law was enacted was there are out-of-state banks charging Ohio borrowers 28% on credit cards. That's why this applies to revolving credit agreements. And they felt that that was they were at a disadvantage. Ohio banks could only charge 25%. But politically, they didn't want to have a statute that said, okay, Ohio banks, you can charge whatever you want. So instead, they wrote it in a way that it becomes a fairness issue. And it is true. I mean, it is fairness with the other banks. But oftentimes, it's what makes the law difficult to read, because it's not written in a straightforward manner. It's written in a bit of a convoluted manner so that it is easier to enact and easier to sell. Now, because this was enacted after the financial crisis, we do see this definition of revolving credit agreement to get rid of residential mortgages, because the residential mortgages were a big concern after the financial crisis. So this unlimited interest rates, which is essentially what this provision is, does not apply to revolving credit agreements secured by residential mortgages. So I find this interesting because it's really a perfect example of sort of the political process that shapes the laws that ultimately the financial institutions must comply with. And of course, as a lawyer, these kinds of convoluted ways of writing the law, I suppose, keep us employed. But they can create a challenge because if you don't know the history, it may not jump out at you. But the bottom line is that on open-end credit, Ohio banks have an unlimited interest rate because essentially all kinds of rates are permitted to be charged by other banks that do come into Ohio. So to really kind of summarize the power issue, which is key, state banks are generally limited to the powers granted to national banks with some certain limited exceptions. And that states will tend to grant the maximum powers because of this competition between the state and the federal charters. Because we're talking about state chartered banks and the state is their primary regulator, if they want to expand into new activities or have new ideas, it's their state regulator that they must go to. We've been talking previously more about national banks that would go to the OCC. Ohio banks will go to the Ohio Department of Financial Institutions. And the state banks must all obtain FDIC insurance, and that really kind of limits what the state can permit because they're always under the FDIC and those restrictions. So we're going to go on in our next module and talk about preemption again with usury, which is the type of preemption that applies to state banks. And I think it will illustrate sort of the benefits and also the limitations of operating with a state bank. So as always, reach out if you have questions, and thank you.